Hey there, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, January 24, and you're tuned in to On Trend, the show designed to keep you on the right side of the trend. So we want to continue to keep things in perspective, so we'll look at the different trends on the different time frames. I'm going to go over wedges and why I view some wedges as suspect and some as more robust, and I'll also rant about trend lines. We'll look at the short-term uptrends in the major index ETFs, as well as mark key supports for the big six sectors. And finally, we'll look at the bond market, which could be turning up. The long-term versus the short-term. Basically, we have different trends on different time frames. So I think it's important that first, we need a strategy. All right, you need a strategy when you go into trading. And part of my strategy is I first look at the long-term trend, the bigger trend. Now, long-term and short-term, of course, different meanings for different traders. Somebody, the short-term may be a few hours. Somebody, the short-term may be a few weeks. For me, pretty much I'll use the 200-day moving average and sometimes the 50-day moving average for my long-term outlook. And I'll use a one-year bar chart to try and get an idea of the bigger trend. All right, putting a definitive time frame is kind of difficult. I can't say, okay, this happened, it's going to last for the next 7 months. No, it doesn't work that way. Basically, you're looking at your chart and you get a signal. All right, so when I look at this daily chart for the S&P 500, clearly we got some signals there in October when we broke below the 200-day. We also had breadth signals, and then we had a couple of failures here at the 2800 level, and then we broke down again there in December. So I think we're clearly in a long-term downtrend. You can also see the 50-day moving average is below the 200-day moving average. So that tells me that the long-term trend, as far as my long-term is concerned, is down. Now, you'll get a different perspective if you look at the short-term. But before we do that, just note that, mid-caps are also in a long-term downtrend. 50 days below the 200-day, prices below the 200-day, new 52-week low in late December. Same for small caps. And same for the NASDAQ 100. That was a 52-week low in late December. So short term, we have a different picture. And that's the reason I'm starting with this long term, because I'm going to rant about wedges in a little bit, because I only look at wedges, rising wedges. I only consider them bearish when the bigger trend is down and they're a counter trend rally. And I'll show you that in more detail. But if you look at the short term, okay, clearly we're in an uptrend, all right, on all of these. They've moved sharply higher from late December to the middle part of January, and it's been a big move. But you know what? You got to keep that move into perspective. All of these indexes are below their early December highs. All of them are below the 200-day. And all of the 50 days are below the 200 days for all four indexes. So this is a short-term uptrend within a bigger downtrend. So which trend carries more weight? Well, clearly, or for me, the long-term downtrend carries more weight, and that is going to influence my trading decisions going forward. Now, I'm not very keen on shorting stocks. I'm not very keen on long-term downtrends, which would be considered a bear market environment, because trading is choppier, risk is above average. So, I personally kind of move mostly to the sidelines during a bear market, and I think that's what we're in. Am I worried about missing something? No, I'm definitely not worried about missing something, because there's often a second chance. And so I don't think this rally that we've had changed the long-term outlook. I think we're still in a bearish market environment. So now let's look at a couple of indicators. This is a percentage of stocks above the 200-day moving average. We've seen it before, and it is still long-term bearish. And the reason I'm showing this one is because I've got a shorter-term version to show you next. But I mean, look at this. 41% of stocks in the S&P 500 are above their 200-day EMA, less than 50%. Gets much worse when you get to mid caps and small caps at 33 and 30%, and 49% of the NASDAQ 100 are above their 200-day EMA. So this is a long-term indicator. I get a bearish signal when it moves below 40%, as it did there in mid-October, and that shows enough critical mass on the downside to warrant a trend or a bear market environment. And you can see it hadn't been below 40% since the early part of 2016 there. So if we look at this bounce, I'm not going to take it seriously unless we get above 60% in two of these three indicators. All right, so that sets the long-term bias again. Now, short-term, we've got an overbought condition. Now, I don't look at overbought conditions when the bigger trend is up, all right, because overbought conditions are actually bullish when the bigger trend is up. But when the bigger trend is down and you get an overbought condition, that is a potential negative, or it could lead to a reversal. Now, we know that things can become overbought and remain overbought. Case in point, you can see this percentage of stocks above the 20-day EMA indicator moved above 70 2 weeks ago, and that's overbought. So it's been remaining above 70 for 2 weeks. And as I've shown this chart before, if it moves back below 70, that would suggest that these stocks are turning back down and the overbought condition is being alleviated, and perhaps the market is turning down. But we can see that all three are above 70%. And when these start moving below 70%, that would be a signal that we're turning back down in the market. Now, I've noted some bearish reversal patterns in Don't Ignore This Chart and a post yesterday. And also want to point out that we had basically a bearish breath thrust 2 days ago. And what we want to see when we get selling pressure is we want to see mild selling pressure. And if we look at the selling pressure that we had 2 days ago, which would be Tuesday, we got below minus 70% in S&P 1500 AD%. There you can see that indicator. So that is a lot of selling pressure, and that's a downward breath thrust. We didn't quite hit it in the S&P 500. We did hit it in the S&P 400, and we did hit it in the S&P Small Cap 600. So we had some pretty strong selling pressure, and that again could suggest that the mood is changing as far as stocks are concerned. And we'll get into that in more detail. All right, now I know this is going to go against some of what we've been taught in the traditional technical analysis textbooks, but over the years, we learn the basics, but over the years we develop our own styles. And I'm not saying one style or one interpretation is necessarily right or wrong. We're all right at some point and we're all wrong at some point. But I think we need to quantify rising wedges. I think rising wedges in a long-term uptrend are suspect, and rising wedges when you're hitting a new high are suspect, and I don't even draw them. In addition, I don't think trend lines mark like a support or resistance level based on demand. A trend line is basically reflecting the momentum behind a move with its steepness. So let's take a look at this. Now, perhaps the most important thing that I can get across here is that just because you read it, hear it, or see it doesn't mean it's true. And you need to go back and see for yourself how something worked in the past to see if it has a chance of working in the future. And I can pretty much take most technical indicators and most technical signals, and I can show you good signals if I want, and I can show you bad signals if I want. That's just the way it is. It's open to interpretation. So here's a weekly chart of the S&P 500, SPDR, SPY, going back 10 years basically, and we can see a number of rising wedges. And we get some breaks, and that led to the kind of a bearish situation in 2010. And we had another break, and that led to a bearish situation in 2011. And we had a break in 2012 that didn't amount to much and went to a new high. We had another wedge break there in latter 2012, and that didn't amount to much because we went on to new highs. Had another wedge that was never broken. We had a wedge that was broken here. That didn't amount to too much. We had a wedge form, but not really a break. And then we had that mess in 2015. Another wedge break that didn't work out in August 2016. And then the biggest of all wedges here in 2016, 17, and 18, and the breakdown. So you can see that wedges work maybe half the time at best. But I think the point we need to really focus on is if we're hitting a new 52-week high, we probably need to ignore bearish patterns. And if we're above the 40-week moving average or 200-day moving average, we'd probably be better off ignoring bearish patterns because trends tend to extend longer than we expect. Now, if we look at a daily chart, we can see a number of wedges as well. And here we are, we're hitting a 52-week high. All right, and then we break down from the wedge, but it doesn't amount to much of a reversal. Again, we hit a 52-week high and we break the wedge, no reversal there. Another wedge break and no reversal. And then we had this big blow off top here and a sharp decline, and there's probably a wedge break along the way there. And then we got into the choppy period in 2018. So we got a wedge break that worked pretty well, and a wedge break here that maybe not. This wedge break didn't amount to very much. This break here, getting a bad whipsaw because it surged to new highs. And I could probably draw another wedge if I want here with these lines. So you can see this one worked out really well and called a top. But you can see that in an uptrend, the trend is usually the dominant force. All right, so I would ignore, personally, bearish patterns. I wouldn't look for a rising wedge to be bearish when you're hitting a new high. However, if we're below the 200-day and we have a rising wedge that is a counter trend bounce, then I pay attention. So let's look at some of these. Oh, one more thing. I also rant on trend lines, but what does that lower trend line tell you? Well, it tells you how steep that advance is based on this low and this low. And the steepness of the trend line reflects the sharpness of the advance. So you can see this advance was much steeper than the next advance because the trend line wasn't as steep. When you break the trend line, that tells you that the rate of change or momentum is changing. Doesn't necessarily mean you're getting a downtrend. Okay, it just means momentum is changing. It's kind of like a negative divergence in MACD when it's still positive, or a negative divergence in RSI when it's still at like 65. All right, momentum is still net bullish. It's just less bullish than before. And so we can see these trend line breaks are just telling us that, something is changing with regard to momentum, but it doesn't always give you a trend reversal. So now let's look at some of these wedges in SPY, QQQ, and IWM. So when it comes to the broader market, we basically need to watch what's going on with SPY, QQQ, and probably IWM. They are the three big ETFs, if you will, to watch as far as I'm concerned. I also like MDY and IJR, but I do not like DIA. I don't like the Dow because it's only 30 stocks and it's price weighted. And, signals just don't seem to work as good for the Dow. But on this chart, I don't have the 200-day, but we know we're below the 200-day. And I've got RSI 14 period, and I've got a red line at 60. Because if you're in a bigger downtrend, typically momentum peters out when RSI gets up to around 60. Sometimes it goes above, but if it goes above that, into that 50 to 60 zone, then you kind of watch out for a move below 50 to signal a downturn back in momentum and possibly a short-term trend reversal. So you can see here on this chart, SPY fell 16% and then it rose 14%. So still, this is a massive advance, but it still is in the shadow of a bigger decline. All right, we had the gap up 3 days ago, and then we had some weakness on Tuesday and then firmed on Wednesday. So we've got kind of a short-term support there at 260. And you could draw a rising wedge here if you want with a very steep trend line. If you draw it on the 60-minute chart, it doesn't look as steep. It looks more reasonable. It looks about like a 45-degree advance. But again, that trend line is capturing the momentum of the advance, and it is marking the boundaries of this pattern. That's why I use lines on my charts to mark the boundary of the pattern. So a rising wedge, a rising flag, a triangle, a falling wedge, those type of patterns I'm using lines to mark. I'm not marking so-called trend lines. Now this trend line is basically reflecting upside momentum. So it's strong. So we break below this trend line, that tells you momentum is slowing. Okay, upside momentum is changing. And yeah, sometimes a momentum change can foreshadow a bigger trend reversal. But as far as demand is concerned, where was the last place prices held and demand picked up? Well, there's that bounce off that 260 level. So that was a good spot of demand. You can maybe even go back to 256 if you want, this low here from mid-January, but I'm going to use 260 short term. And notice that we had a gap up and then a gap down. So we got a little reversal. We tried to open strong yesterday but fell back. And if we break 260, I think that's going to reverse the short-term uptrend in SPY and call for basically a continuation of the bigger downtrend. Here's QQQ, and I featured QQQ yesterday in Don't Ignore This Chart because of the evening star. So the evening star forms with a white candlestick, so you get that surge, and then you have an indecisive candlestick. So you have, a move up, a move down, but you finish kind of where you started, so that's indecision. And then you have a gap down and a long black candlestick. So that's a 3-candlestick reversal. And we went below that low 2 times over the last 2 days, but rallied back. So there is a support zone there to watch on a closing basis if we break below it. And you can see RSI is in that 50 to 60 zone for the 3rd time in 3 months. So if it breaks below 50, that's going to be a momentum negative. And if we look at the 30-minute chart for a little bit more granularity and detail on this setup, we can see another pattern taking shape. I pointed this one out here, this little wedge, and we got the breakout. But the breakout, it's kind of getting a test already. It's not continuing higher with a lot of strength, so it's waning a little bit. But a smaller wedge is taking shape. And you got to watch out. If we break out at 164, we could move to new highs. So I do take horizontal support levels more seriously than, say, a momentum turn with a trend line break. And if you look at this chart, you can see where the horizontal support levels are because we held this 158 area, 158, 159 area twice. The breakout's not holding, but if we break down below this support level, that's going to reverse the uptrend in QQQ. And then we have IWM, which, patterns are all looking the same. You can see that RSI is in that 50 to 60 zone for the 3rd time. It did edge just above 60, but if it breaks below 50, that's going to be negative. You got a little reversal attempt working here, and you need to break support to get that reversed, that uptrend reversed. And then there's the wedge. And you can see I'm debating between which level is the first support level because, you have a resistance breakout level that becomes support, but that's not as hardcore of a support level as, say, a prior low. And here you can see that in mid-January, we bounced off this 142 area twice. So that showed a lot of support. And so if we break that 142 level, that's going to be a significant reversal, I think. Now I want to do the same thing with the 6 big sectors that account for 78% of the S&P 500. All right, so now looking at these sectors, I've got support levels marked based on the same low, and that's right around mid-January, the 14th of January. There's a low, and we kind of consolidated, and we got a bounce off that low. So that's where demand picked back up. And so I'm watching this low because if demand cannot hold this bounce and we see supply come in or selling pressure and push prices back below that support level, that's going to signal a trend reversal. And this is XLY. And you can see that it accounts for 10.25% of SPY. So two things I'm watching here. All right. And we're at a potential reversal zone. You know, we're right in the middle of this prior consolidation there. There you can see the middle of it. That's the arrow. I'm going to switch over to the line. But we can see we're right in the middle of that consolidation. We're short-term overbought. So if RSI moves below 50 and price moves below this support level, then that is going to be negative for XLY. So that's one to watch. And there you can see a little more detail on the 30-minute chart. So there was the breakout, and we've got a throwback towards the breakout zone. And if we break 106, all right, we're back on again. But if we break 103, we got to turn bearish again on XLY. We'll look at XLC, the communications sector, which accounts for 10.4% of SPY. You can see that there's that support zone marked by that mid-January low. And if we break that support zone and RSI breaks below 50, that's going to be short-term bearish. And then when we look at the 30-minute chart for a little bit more detail on what's going on, there you can see support from these lows. And you can see that XLC totally didn't hold the breakout. It moved back below the breakout zone. It actually pierced this low. So it is the weakest of the 6 sectors because it actually moved below that 14 January low. So watch out for this one. We look at XLK. We can see that it surged, and there it is above support there. Had a little gap down on Tuesday that's holding, so we'll watch for a continuation lower, but you can watch RSI to move below 50, and that mid-January support level is around 63. And then get a little detail on that 30-minute chart there. You can see there's the breakout zone. So the breakout zone is holding in XLK. That's the first level to watch. And then there are the 2 lows where we got demand in mid-January and we got the bounce. And if we break below 62.5, that's going to negate that and reverse the uptrend. XLF, I'm not sure what to do about XLF because it's the leader and the laggard. I mean, it's the laggard because look how far below that September high it still is, and it's well below its December high. So it's, you know, it's had the biggest advance and it's got this big gap, but I'm not sure what to do with it. Probably just watch the other 5 instead. You know, maybe there's a little bull flag in XLF and it's trying to break out. We'll look at XLI. You know, again, a big surge, but, you know, below the 200-day. And these are below the 200-day. If you're below the 200-day, chances are you're in a downtrend. Why fight it? Why chase this advance? All right, and we got a clear support level to watch going forward. If we break 67 and RSI moves below 50, that's negative for XLI. And there you can see it in more detail on the 30-minute chart. If you break 67, that's going to be bearish. Of course, got to keep an open mind. If you break 69.5, that gets the bulls back on track. And looking at our last sector, which would be healthcare, it's the only one of these 6 that is above the 200-day moving average there, you can see. And it's back above its 50-day. RSI is in that 50 to 60 zone. But, you know, what do you make of this chart? You know, you got these 2 highs here, and then you got this big breakdown, and then you got this big advance. Well, it doesn't look like a stable uptrend, and I want to be in stable uptrends. I don't want to be in choppy environments. And if we look at the 30-minute chart for XLV, we can see a broken resistance support there, and then support from that mid-January low around 86.5. So it's interesting because stocks are looking a bit toppy and bonds are looking like they want to bottom. So let's look at those in detail. So here's the 7 to 10-year Treasury bond ETF, and in contrast to SPY and the broad market indexes, you can see that it has broken above its 200-day It's broken above its summer highs, and it hit a new 52-week high. So it was clearly overbought. I mean, that's a massive move for bonds. It's like 5%. So we had a pretty sharp pullback. I'm sure if you wanted to draw a falling wedge, you could. We'll look at a 30-minute chart next. But, you know, we've retraced around 38%, and that's kind of the minimum retracement because you come overbought and, you know, maybe you come back to the breakout zone. So we could go back to 103. But I'm watching this closely because, you know, we had this sharp move lower 3 days ago, and then we got an immediate bounce on Tuesday, a bit of firmness on Wednesday. And if we can get a breakout there, I think that's going to be bullish for bonds, and that would go hand in hand with the decline in stocks because, you know, stocks and bonds are opposite ends of the risk spectrum. Bonds are the safe haven, stocks are the risky assets. Now, when I see a pattern like that, I like to focus like this wedge thingy. I like to look at it on a 30-minute chart to try and get some more detail on what's going on. But, you know, there you can see the sharp decline that we had at the end of last week, and then the gap up, and that's not really a gap because it's reacting to the futures market. But, you know, you had a bounce and you got above that wedge trend line. And this is a falling wedge as opposed to a rising wedge. So I'm looking at this falling wedge because I think the bigger trend is up. So that means a falling wedge I consider a correction within that bigger uptrend. And we're starting to break out of that wedge boundary there. And so the first resistance is marked with Tuesday's high. And then if you get above that mid-January high, that's going to be bullish for bonds there. And then if we look at TLT, we can see a similar picture emerging here. We're getting some firmness over the last 5 days or so. So looking for a breakout there to signal a resumption of the bigger uptrend. In the indicator window, I've got CCI this time because, you know, when it moves below minus 100, that's a short-term oversold condition. So we're above the 200-day, we're in a long-term uptrend, and we become short-term oversold. Well, that's the setup for a mean reversion bounce and a move higher in bonds. And then we look at the 30-minute chart for more detail. You can see a clear resistance level to watch, and a breakout there would be bullish. All right, we're going to briefly look at the 10 and 30-year Treasury yields. They open up a little bit earlier. At least they come on our charts a little bit earlier than bonds. You can see I'm doing this at 8:21 a.m. and we've already got a price, and you can see Treasury yields have moved lower, and that means Treasury bonds have moved higher. So this is the 10-year yield breaking out of the wedge pattern, the boundaries, and on the verge of breaking support there. And if we look at the 30-year yield, it has broken support there. So it looks like Treasury yields are poised to move lower and Treasury bonds higher. We look at the junk bond ETF, JNK. It had one of the biggest surges, and that's because yield spreads improved materially over the last 4 weeks. And you can see that it got above that December high. So we have a support zone based on the mid-January lows. And if we break that, that will be negative for junk. And keep in mind that junk bonds are highly positively correlated to stocks. There you can see the correlation with the S&P 500 equal weight ETF, strongly positive, so they move in the same direction. So if stocks turn down, junk bonds most likely turn down. There's some positive correlation with oil. That was up until it was negative in the summer and then positive in the fall. And it's pretty much negative with TLT. So if junk moves lower, TLT could move higher. And finally, utilities are sparking. There's a move above that resistance level from mid-January and a bounce off the trend line. So that concludes this edition of On Trend. Thanks very, very much for watching, and remember to stay on the right side of the trend, the long-term trend.